Thanks, sir, Ishita. And thanks, sir, Carrie. I'll get things started on our end. It's good to see a lot of friendly faces here on the call. And like you mentioned there, Carrie, it's great just the amount of growth, membership, and where this is all moving, because there's a lot of faces I don't recognize, which is also amazing as well. Maybe just by a way of quick introduction, my name's Ryan. I head up climate innovation and investment for a company called Autodesk, which is a kind of a unique role here in that I lead an overall climate strategy for the firm, as well as a number of different vehicles we activate to be able to take some action on that strategy. And one of those is actually the foundation of Autodesk Foundation, which is the company's philanthropic arm and really sort of pioneering what we could be doing as a business. So one of those elements is around forward impact analysis. And of course, that brings us all here together today to be able to have a conversation on how that shows up in our investment practice. So maybe I'll just spend a moment, sort of setting the table on how this investment thesis and the Autodesk Foundation fits within the overall corporate impact strategy of the business. And then I'm going to pass it to my colleague, Ishita Jain, who really spearheads, a lot of the impact management and forward impact assessment work that's critical to it. Thanks, sir, Ishita. So maybe just by way of introduction, Autodesk itself is a large software company. It's headquartered out in the San Francisco Bay Area, and it creates tools for people who are making things. Right. So many of our customers are the largest firms in architecture, engineering, construction, manufacturing, the media industries. And you might be sort of familiar with AutoCAD, which was sort of the flagship product way back in the 80s. And that brought sort of drafting from pen and paper into a digital world. And now the company has something north of 150 different products and about a $50 billion market cap. So the firm really is no stranger to sustainability and impact. And I think that really comes from this recognition that the tools that are being provided into the marketplace are really directly influencing what gets designed and made around us. And that's across all different scales, right? From skyscrapers to cell phones. And so therefore, the company has really invested heavily in taking that responsibility around sustainability seriously, really for decades at this point. But important to notice that, what you see here on the screen is actually the first time the firm has a sort of corporate governance against an integrated impact strategy for the company. Right. So it's about 18 months ago, the firm ratified this impact strategy, and it really outlines both the what we mean by impact and how we aim to be able to achieve it. I won't go into too much details around what it actually means, but maybe just like a quick, brief overview. There are 3 what's around impact, which we define as energy and materials, health and resilience, and work and prosperity. Really, the 2 big intersecting circles there are around climate change and equity, showing up both in mitigation and adaptation, as well as in workforce development. In terms of the how, maybe just really quickly there, Ishita, before we jump forward, we're driving impact through our operations, like most companies, through our products, tools, and our customers, which is really core to the business model here at Autodesk, and by using our position within the broader ecosystem to advance our industries to being more sustainable, more equitable, more resilient. And on that last piece, which is really the focus of our conversation today, we can do that through policy and standards and coalition building, but we also do it through catalyzing innovation, right? And Autodesk Foundation is that vehicle to be able to do that catalytic support of early stage innovations that are advancing those industries to be more sustainable, equitable, and resilient. You mind jumping forward? Great. So just a little bit about the foundation. There's 50 active portfolio organizations globally. It's a mix of for-profit and nonprofit business models, technologies, really leans more direct these days, but we do have some fund exposure. And it really sort of spans a lot of different asset classes as well. When it comes to this conversation around climate mitigation and emissions reduction, predominantly that shows up in this energy and materials side of the portfolio, which itself is a portfolio of market-based technologies that are what we say decoupling economic growth with emissions, really focused on architecture, engineering, construction, and manufacturing. And for us, the investment takes the form of capital, mostly as early stage venture capital and some private equity, also a little bit of debt. But more interesting, really brings investment in the form of in-kind value of Autodesk, right? Which we sort of break out into these 3 buckets: with our technology, with our talent, and with our sort of customer go-to-market and marketing functions. We just really find that to be really powerful for early stage innovation, right? How do you bring our customers and markets closer towards innovation, de-risk the technology development and manufacturing of those products, and then provide the catalytic capital to be able to overall sort of drive enterprise value and accelerate their adoption and scale. And just to give you kind of a overview of how we're structured, right? The investment professional team is really only 5 folks, but the post-investment team is about 15. Right? And so they're really sort of structured to try to work with Autodesk and bring those capabilities to the portfolio, with impact intentions. In terms of how we make decisions, again, sort of threefold here as well. The first being around impact, just getting our heads around if this is successful, does it really matter for solving climate change? And so on a forward-looking basis, really setting that bar around 500 million metric tons of carbon dioxide equivalents by 2050. Ishita certainly will share, a lot more around that. The other two pieces being, can this venture actually be successful, which I would sort of define as traditional venture diligence around the team and the business model, the markets and the technology. And the third, which is what we just talked about, really what is Autodesk's role as a company to try to help catalyze that success, right? Through the different programs we can bring to bear, or new ones that we need to start, just to try to help that growth and scale. The last thing I'll just mention is that we're structured like an evergreen fund as well. It's housed within our charitable accounts that are away from our balance sheet, and it's capitalized at 1% of operating income for the business. So we're deploying about $15 to $20 million every year. We operate it like it's a $250 million vehicle. When we think about success here, right, of course, because we're using our philanthropic assets, it's first and foremost about impacts and driving our industries towards decarbonization. We're thinking about financial returns to be able to grow this pool of capital over time and do more of this type of industry transformation work. And then we're thinking about the strategic relevance to our overall impact strategy. I think the portfolio today is 18 companies and sort of ranges from seed to Series B, as well as 3 different funds as well. And this is the last thing I'll mention, before I pass it here to Ishita, is because we're thinking about value across impact, finance, and strategy, it becomes critically important to have a sense of what success could look like on that first bar, right? So forward impact assessment and holding ourselves accountable with rigor and credibility to the impact outcomes we hope to drive from these investments is tremendously important, not only for the foundation's work, but also how we think about bringing it towards Autodesk and our overall strategy. So maybe Ishita, I'll pass it to you to share more on details there.
Yeah. Thanks, Ryan. Like Ryan mentioned, impact accountability is really at the core of what we do, and even more so because we're, the foundation of a publicly traded company, and therefore, we're accountable to our board of directors, our stakeholders, shareholders, customers, etc. And we report our metrics externally via our impact report, as well as through our ESG raters and rankers like S&P, CSA, etc. So, maybe as I start, I'd love to provide an overview on our impact assessment approach overall for all 3 impact opportunity areas. And so at the highest level, when we think about this work, we're really interested in integrity, impact alignment, and value for our investees. That's really how we're structured, and that's how we think about this work. We manage our impact assessment in-house and with the help of external consultants like Row Impact and CEA Consulting. And working with these neutral third-party experts really gives our assessments the credibility and helps us scale this work. We also rely on tools like the Crane tool, which is developed by Prime Coalition and Row Impact. And really that is to help us get a level of standardization and really compare these analyses, across the board. For us, when I say impact alignment, what I really mean here is looking at this process of building these forward-looking assessments and models to really have a dialogue with our entrepreneurs and founders on impact, right? And just getting really clear on what are some of the assumptions here, what are we really talking about, and how do we move forward together. And lastly, we want to make sure that the analysis is equally valuable for our investees, right? That they can then have the confidence to speak about their impact, potential impact with their other stakeholders, as well as make informed decisions. So that was an overview of our process. And now I'll dive into the process. Again, there's a lot on this slide. It's not meant to be read. I just wanted this to be illustrative of the kind of theory of change we've built out here. And in the green box below, you'll see the impact outcomes that we have sort of arrived at in terms of what are some of the things that we're really looking at from our investments. And on the climate side, this really looks at potential impact and realized impact. The criteria for us is really looking at pre-investment, making sure that we have the conviction that, you know, there is enough there to make these investments. And so our investments focus on solutions that have the potential to mitigate or remove more than 500 million metric tons of CO2e by 2050. And then post-investment, we want to just continue to refine our models. And as companies come to market, really be able to track realized impact relative to commercial sales. I won't dive into a lot of details here, but the process that we use, we apply the emission reduction potential framework, which is the ERP framework. And we really focus on potential impact rather than planned impact in our due diligence stage. So really looking at the potential of the technology rather than the planned impact of the organization at this stage. A little bit on our post-investment. Again, this is something that we're really looking to build out and do more of and do better in. So really looking to then build our planned impact model and then revisit this assessment to compare actual performance relative to what was projected and continue to update our assumptions with time. In terms of reporting and disclosure, we do have an annual report, annual reporting cycle, and we do report internally as well as externally. And one of the things that we're trying to do more of here is really bring in more verification and audit support to be able to credibly report this data. And then lastly, in terms of evolution, I would say, we have a consulting model. So that coupled with, being on working groups like Project Frame and other impact measurement and management working groups, we're constantly learning from experts and, all of you, this entire community, and really bringing that back to our practice. I think a few things that I'd like to leave you with, things that we're grappling with right now is, how might we further our impact assessment from a due diligence tool to an ongoing operational decisions tool, right? Like, how do we really make that switch? Secondly, our consulting model is working really well for us so far. It's helped us like resource and scale this work. However, as our portfolio grows and matures, how might we be creatively resourcing for this work? Because that is definitely a challenge. And, a question is like, can forums like Project Frame, where we're looking at standardizing some of the methodologies and really thinking about this, like, is there a world in which we can have shared impact assessments across the board, when we're looking at similar organizations? And then lastly, my role is looking at impact measurement for the foundation as well as ESG reporting for the company. And as we see these worlds converge, it's really about thinking, how might we bring learnings from this forward impact assessment analysis into some of those Autodesk corporate-wide impact strategy reporting. With that, I'll pause here and open it up to any questions.
Thank you so much, Ishita. In the interest of time, I have one question that we received in the chat that I'd like to start with, and then we'll let Melina present and then do the rest of the questions a little bit after. But do you find that there's any tension between the corporate form and your foundation when it comes to your impact goals?
I would say that at this point, yes and no. I think, at the corporate level, a lot of the work that we're doing around ESG is slightly differently framed. However, and looking at our portfolio and our impact metrics here, however, I think I do really see lots of opportunities for, one learning from the other and really being able to apply that.
Thank you. Ryan, was there anything you wanted to add before we turn it over to
I love the
Melina?
question. It's something we get to spend a lot of time thinking about. The one thing I'll just add as that's additional is sort of recognizing that impact can be driven through this business, but not necessarily beholden to the business is something we have to think about in governance a lot. And so that sort of shows up in how we define success and how we govern towards that success. Thank
you. That's really interesting. Melina, would you like to go ahead and share your slides? Thank you so much, Ryan and Ishita. We'll have some more questions for you following Melina's presentation as well. Perfect.
Hi, everyone. It's a pleasure to be here. Thanks for paying attention to these investor presentations. My name is Melina. I'm a principal investor, as I said, at AENU, an evergreen impact fund. And I'll spend the next 10 minutes giving you a very high-level overview of some of the aspects of our impact in the investment process, but our full investor report is online, and you can see a lot more details there. So I'll start a little bit talking about our theory of change. We depart from the belief that financial capitalism is broken, and that has led us to the climate crisis that we are facing right now, as well as social inequalities. And therefore, we need to reinvent this system. That new system for us is what we call impact capitalism, which optimizes for social and environmental well-being. For us, applied to what we do, which is venture capital investments, we have three main levers to use to get to that impact capitalism idea. The first one is obviously to invest in early stage startups that are specifically working towards social and environmental outcomes. The second one is what we call leveling the playing field. So redefining the rules of the game, not just who has access to the venture capital asset class, but also who receives our money. And then the last one is what we call paradigm shift, which is rather about how can we get outside of our bubbles and spread the ideas of impact capitalism and impact in general to other stakeholders like policymakers, corporates, etc. And to get there, we realize that there are two main barriers. The first one is that the traditional venture capital model is very strict. So companies are expected to have a very specific timeline to exit. And the second one is that investors are not able to support startups in their growth journey unless you have a growth stage fund or you have a continuation fund. And therefore, to address those barriers and to get to that impact capitalism concept, we created this evergreen structure. On the one hand, we are able to invest in startups and create in startups that have a different timeline to exit and create a portfolio that is what I call a little bit more fun. So has a different type of risk return. That means that we invest in software companies that are scalable, but at the same time in deep tech companies that might require more than 10 years to scale. And then the other one is that we are able to support startups both financially and non-financially in their growth journey. So round after round and be there for them in the long term. So that's why we chose this evergreen structure. I believe we are one of the few evergreen structures focused on impact in Europe, but I'm sure there are many more cases out there. And in terms of how, what type of impact we are looking for and how we decided to focus on these. So we are an impact fund, not just climate, and therefore we have two primary goals. The first one is GHG emissions is quantifiable, it's easy to compare technology by technology. The second one is well-being, which is a little bit of a catch-all phrase for everything social, but we use the OECD framework for well-being that underlies different types of well-being aspects, whether it's job quality, environmental health, etc. And then we have secondary goals here, also understanding that the climate crisis is not just about carbon. We also have to take into consideration biodiversity and water in many of the technologies that we are investing in. And for all these goals, we look at breadth and depth of impact. So both the scale, but also the deepening of that impact that we are looking for. And we quickly realized when we chose these goals that, other funds use thematic approaches to decide where to invest. In our case, we decided to choose what we call impact investment thresholds to then filter out areas that we want to prioritize on and that we don't want to invest in. And so on the GHG emission buckets, we decided to focus on 100 megatons of CO2 emissions avoided or removed at the technology level and at a scale. And I'm increasingly more surprised about how many funds are using thresholds like this, which is really good to see. And so in our case, we decide at the technology level and not at the company. That means, for example, if we think about alternative proteins, it would be the entire category of alternative proteins, or one segment of it could be, for example, chicken, versus just looking at the potential impact of one company. And on well-being, we focus on well-being of X number of people improved. And obviously that's an outcome metric. It's not an output metric. It's not an outcome metric, but it's very difficult to roll up outcome metrics on the social bucket. And therefore, for us, at least when it comes to rolling up and presenting these numbers, we focus on the number of people. But for each investment we do in the social bucket, we have outcome metrics as well. So this is a little bit about how we screen from a numeric standpoint. But I wanted to show you a little bit of a deep dive here, or a case study of what we do at the screening and then at the impact analysis level. The guidelines and the process, again, it's in the investor profile, but here I'm going to jump into the details into this example. So the first step is doing this, what we call impact screening, and it has 6 criteria: intentionality, impact logic, interlock, depth and breadth, additionality, and impact measurement. And for each startup, we go one by one and see if it meets our guideline or not. So in the case of Next-Gen Foods, which is an alternative protein company, so they make alternative chicken out of soy. In terms of intentionality, the founder had already turned their family business, which was this typical German schnitzel meat company, into an alternative proteins company, only producing this type of products. And therefore, we were convinced the intentionality of the founder was there around climate goals. When it comes to impact logic, for us, this is more of the theory of change, making sure that the product is actually solving the root cause of a problem and understanding the logic steps to get there. And of course, in the case of alternative proteins, it's very straightforward. We know that there is an immense potential of emissions reduction if people substitute their current diets for something that is more plant-based. And we also know that one of the key levers to increase the share of this type of plant-based protein diets is taste, texture, and obviously price parity, all of which are targeted by Next-Gen Foods. Then we have interlock, which is about making sure that there is no commercial success without impact success. And at the core here is the product. If the company changes the product, it's not Next-Gen Foods anymore, it might be something else. And that interlock point is also met. Then depth and breadth, I'm not going to go into the details here because we'll see a little bit of the impact analysis in the next slide. And additionality is, as we all know, the concept about seeing what are the solutions that are in the market and how much better the solution that Next-Gen Foods puts forward is. And obviously, they have gotten a lot of positive feedback. And we know that non-vegetarians and non-vegans are also buying these products, which is different from many companies that are out there and are targeting vegetarians and vegans, which defeats a little bit of the climate purpose here. And finally, impact measurement. The company has not run its own life cycle assessment, but we use a proxy for an alternative chicken company, at least as a baseline. And obviously, as a company has the capacity and resources to do such an assessment, they will do so. So that's the screening process. When it comes to the impact diligence process, and I'm not going to go into every point here, we follow a 6-step approach as well. The first one is impact research, understanding what the academic community says about a specific impact problem. In this case, obviously, it's again about alternative proteins. We look at IPCC research and other sources to ensure that we have the latest information and data about that impact problem. And then we do an impact sizing. This is top down. This is about making sure that the technology meets our impact investment thresholds. And in the case of alternative proteins, for example, we look at the data, in this case, 8 gigatons of annual emission reductions potential if everyone became vegan, which obviously is not going to happen. And therefore, we then look at the penetration rate of alternative proteins by a certain year to at least set that baseline of how the industry is going to move forward. And that's how we do first the impact sizing. And then we also do bottom up. So Autodesk, for example, said that they just look at the top-down approach, but not at the company planned impact. In our case, we do both. And so when we are doing our commercial analysis, we also do this impact analysis, which takes into account the impact units. It could be a life cycle assessment, for example, in this case, or it could be other type of operational data, and then project the climate impact, whether it's CO2 emissions, whether it's a specific biodiversity metric or water metric, up to 2030. And we use the emissions reduction potential framework as well, to the extent that we have available data and that we can use it and it's applicable. And I cannot emphasize enough how important and sometimes also how overlooked impact risks are. We also make sure that we understand what are the specific things that could go wrong, or specific aspects of a company that can be improved from an impact perspective, which is also something that then after we invest, we bring to the impact and ESG workshop that we usually do with our startups to try to refine and support founders to increase the impact efficiency of their products. And obviously, we also do ESG assessment. This is not just mandatory by SFDR in Europe, but is also a standard in venture capital. And we'll have a very well fleshed out ESG assessment that we do with all our startups. And without mentioning a lot more of our impact process, which I can go on and on for hours. I just wanted to give you one highlight of something that the team thought might be interesting for the audience, and that's our carry. We actually have carry as a venture capital fund for every member in our team and not just investors. We decided this pretty early in our conception. It's part of, again, our theory of change, of leveling the playing field. Every team member matters. And the way that it's calculated is just through a point system that is then distributed across a team on a quarterly basis or annual basis. And so I think this is something that I wish other funds would also think about as well. And yeah, we are very excited that we are sharing the benefits of not just commercial, but also climate impacts with all of our employees. So that's a bit of an overview, and I'll leave it here if there are any questions.
Thank you so much. That was fascinating. And I must provide a shameless plug. A lot of your due diligence questions are in using the same language. We're using the frame methodology. So that's always great to see. We have one hand raised, and then I had a couple of questions from the chat. Anna, would you like to go ahead?
Thank you. Thanks, Melina, for the presentation. I have two questions for you on your impact thresholds in screening. One is whether you've placed any time bounds on those targets in terms of emissions or well-being. And the second, I thought it was really interesting. You had the 100 megatons per company and 350 for the fund level. I was wondering if you could share more about how you thought about kind of the quantifying the impact risk, as you explained, given the size of your portfolio.
Yeah, thanks for those questions. On the time scale, so we specifically say at the technology level at a scale, and we leave it a little bit open for a reason. We think that different technologies will scale at different points in time. Plus, our evergreen model is such that in reality, you know, the impact is never ending. And therefore, we don't have, say, a specific 2040, 25 timeline for those calculations. But right now, at least to start with, we are calculating things by 2030. We are still thinking and refining our methodology, to be honest, and the evergreen structure might mean that our approach is different from other funds, but that's how we are starting. And then when it comes to the fund goals, so we have, just like any other VC, a portfolio fund model. So a number of companies that we want to invest every year, the probability of success of those companies, the type of companies that it would be. And based on this fund model, we then project our climate goals and calculate the potential impact for the fund by 2030. So it's really based on this portfolio model, and that's how we get to that number. Obviously, the model is full of assumptions, just like any portfolio model, but at least we know where it comes from, and we know what type of portfolio we are building. And that's how we also embed, as you said, the risks in it. So the risk of failure, the risk that the impact, you know, might drop off, like those are already accounted into that portfolio model that we have internally.
Thank you, Melina. I have two questions from the chat. One first for Ishita. And this question is, do you find that companies seek you out and they try to say what their impact could be? Or do you seek companies and then you work with them to figure out what their impact potential is?
Ryan, I wonder if you would want to take that.
Sure. I would say the short answer is both. You know, sometimes when we have a specific thesis and we go and take a look at which companies might fit that, they don't necessarily speak in climate assessment terms that we're sort of quite technical in this conversation. And so in that way, I think, as Ishita had mentioned, you know, thinking about where you bring them into the diligence process can actually help bolster their literacy and knowledge in a way to be able to communicate. I see as sort of a value add to the entrepreneur. Or it's the other way around. And, you know, folks sort of have used tools like those that have been shared in the chat here and have a sense of, you know, how they might talk about their climate impact and are just looking for, you know, more signals of credibility to it.
Thank you. And then another for Melina. And then if those want to raise their hands, we'll be happy to do that. Let people speak up as well. For Melina, on one of your slides, it mentioned biodiversity as an area for investment. Can you give an example of an investment that you thought could be financially successful, but also focused on biodiversity?
Okay, so there is one investment that is not 100% close, so I'm not going to name it, but I'm going to explain what it is. So it's a company that uses different devices to measure the biodiversity in a specific location. So those devices could be, for example, sensors. It could be also satellite data, and they triage, and they have a very robust methodology on how to calculate the net biodiversity gain. So it's backed by science as well. And so that's one example, but a very similar example, we have not invested, but in the same area as that, is the eDNA trend that there is these days as well, of getting a little bit of like water, for example, from a river or from a lake, and then understanding the microbiology around it, and therefore also understanding the biodiversity. And if you measure over time, then you can also see the changes in biodiversity over time. So those are two examples of biodiversity investments, and definitely a lot of commercial success, well, hopefully commercial success, but a commercial case in that there are lots of corporates with biodiversity pledges that are also trying to understand their own biodiversity in the supply chains. And they are partnering with the startups like these through, for example, biodiversity credits. So I'll stop there, but that's one example.
Wonderful, thank you. All right, I have another question for both from the chat. How concerned are both of you with the quality of GHG mitigation? What do you do to assess the quality of this data, and how transparent are you on data quality in your reporting thus far? That's to either of you, so whoever wants to go first.
I can take a stab. I mean, yes, this that is definitely one of the big considerations, like, you know, how garbage data in is garbage data out, like that, like for like definitely that is a very big consideration as we think about this. And we're just making so many assumptions at so many levels to get to this analysis that it's really important to be grounded in the sources that we're looking at. And really thinking through the credibility of those data sources. So great question. I don't know if we have any sort of solution for this. I think we're just trying our best to get to the best data available. I don't think we've thought about investing in more data gathering and like research initiatives that can help with like really specific sectors where there's definitely a challenge in having good quality data.
Melina, and then I have a comment.
I don't have a lot more to add other than we launched in July, so we haven't even gone through the first reporting cycle yet, which I'm very excited and scared to do at the same time. But in terms of data quality, we try to obviously use primary sources, triage, work closely with founders to understand where the data comes from, but we don't have robust, say, processes to audit that data just yet.
Thank you. And I will say these are the sorts of questions that we're grappling with as part of the Project Frame Data and Tools Working Group. We definitely don't have all the answers, but we're working together as a community to try to figure those out.